me today is Joe Davis, President and Financial Advisor at Stonebriar Wealth Management. Joe, thank you for being with us today.
Jonathan, thanks for having me back.
Joe, last week we saw the worst drop in the market since March 2020, which back then it was very obvious that was driven by the pandemic. What's driving this drop this time?
Sure. Well, the Fed raising rates at a much higher rate than anticipated was certainly a very big factor. And frankly, there's an exploding sentiment of a recession being imminent, and that wasn't priced into the market very recently. And it's an unfortunate turn of events. It felt like at May 20th, that was really going to be the bottom here in a lot of sense, where we had a really nice kind of drift upwards into green territory for a little while, away from that bear market risk. But here we are today, well into a bear market, and really trying to decipher what happens next. But if you had to pinpoint any one or two causes for the sell-off, what brought us down about 12% in 7 or 8 trading sessions. The Fed was surprising with their 75 bips rate hike. No one saw that coming. Coming into the week, it was less than a 5% chance of a rate hike of that magnitude. In the days leading up to the FOMC meeting, it became almost a certainty. So with the Fed, with its foot on the gas pedal like that, that certainly was a surprise and a bit of a shock to the market, and it responded the way that it did. After the Fed did what it had to do with raising 75 basis points, investors really felt that a recession could very well be inevitable. And the market also responded accordingly. It was that sense of despondency. The panic had already been settling in, but at this point, investors just felt numb looking at the market sell-off. And as it tends to happen, selling leads to more selling. So I would say those are kind of the two big reasons that we ultimately led to a very severe 12% sell-off in just a few days.
So Joe, what should we be looking for to know that we've hit the bottom?
So it's really been the same couple of factors since we started the year. Since we started 2022, it's been volatile. The market hit a high at January 3rd, and it really hasn't looked back since. And a big part of that was inflation. Reaching peak inflation is going to be critical for this market to know if we've really hit a bottom or not. The second would be Fed hawkishness. Is the Fed going to have to hike another 75 basis points? Will it be a full 1%? If last month or last week's meeting was any indication, the market really doesn't know at this point. So we have to watch for those two things. And lastly, something that no one really foresaw heading into this year was geopolitical risks. The Russia-Ukraine conflict has only exacerbated this sell-off. Until we can have some sort of ceasefire in place, before supply chains can pick back up with whether it's wheat, whether it's energy, whether it's supply chains out of China, the market needs to be able to have a sense that we're moving past these geopolitical tensions. And at that point, we can be comfortable in saying that we have reached a bottom. In the short run, if we can see any kind of deflationary or lack of inflationary pressures on energy, if we can see oil come down, that will certainly lead to a relief rally. It just won't be a sign that the bottom is necessarily reached until those other three factors have some certainty around them.
Joe, where do you think the Fed needs to bring the federal funds rate in July?
So a 75 basis point hike was the largest hike in 28 years. So it was certainly an aggressive move. The market did not see it coming. Up until that week, there was a very low probability that there would even be a 50 basis point hike. Now it looks like that could be the normal. The market actually rallied, in fact, after Jerome Powell mentioned that 50 basis points was still on deck for the July meeting. So that's how sensitive these things are. But at this point, there really is no sense of the Fed completely slowing down. And there's a thing called the terminal Fed funds rates. And that's really, when will it end? When will the Fed decrease its upward momentum on these rate hikes? When will they stop being so hawkish, and surprisingly hawkish, so that the market can have a little breathing room and start to feel supported by the Federal Reserve again? So to answer your question, I think it isn't necessarily a bad thing if the Fed is going to hike rates more and faster. I think some people were even calling for a 1% rate hike for that very reason. We need to get inflation under control. And if it's 50 bips, 75, or a whole 1%, maybe it's better to get it done sooner so that we can get inflation under control. The Fed will have even more mechanisms so that they can reel in the economy and actually stimulate it a little bit by reducing rates. But if we're going to continue raising rates at such a 25 bips here, maybe 50 bips, and not even looking at a 75 basis point hike, I think it could actually do more harm in the short run than it could in the long run, whereas this market is in need of reeling in inflation so the consumer can be strong again, our services can be strong again, and we can see past these inflationary pressures.
And going off, you were talking about the recession being inevitable. I've heard some people say it might be necessary. Do you believe that?
So I really hope it isn't, but economic cycles are normal. Recessions are technically they're 2 consecutive quarters of declining GDP growth. So we've already experienced one of them. It's hard to tell if we're already in one, but if you combine that with high unemployment and a lack of demand, often that's the perfect recipe for a recession. What's interesting is demand is still very high and unemployment is still very low. So for those reasons, it doesn't feel like your traditional end of cycle recession. So that's something that we have to watch very closely. And I think, frankly, that's what has a lot of economists scratching their heads right now to say, is it still possible that we won't have a recession? And with unemployment and jobs still strong and robust, I think there's still enough hope that we could execute a soft landing. But again, we'll need some relief from a geopolitical standpoint in the Russia-Ukraine war and supply chain issues that are only exacerbated by the conflict in Russia-Ukraine, as well as supply chains out of China.
So you just touched on a lot of supply side factors that are driving inflation and the primary drivers in inflation right now, which the Fed doesn't have much control over. So what can the Fed do?
Right, so the Fed has made it very clear that, and by definition, the textbook definition of controlling inflation is something that the Federal Reserve controls by affecting demand. But supply and supply chain is really out of control of what the Fed can do. So if you look at the different factors of our economy that are being affected by inflation, right? You have services, you have goods, you have energy, and you have food. Food, take one of the more obvious ones. We all are feeling the pinch at the grocery store. Overseas, supply chains are only exacerbated further by the Russia-Ukraine conflict. Fertilizer prices have increased. Oil prices have increased. Transportation costs have increased. All of those factors are only made worse by a war that no one really saw coming, and so many people, and innocent people, are just hoping that a ceasefire comes sooner rather than later. So food is a little bit out of control in that regard as far as inflation running away. One that may very well be able to be solved from what the Fed is doing is services. So by raising rates, wages will be affected directly by what the Fed is doing. And if wages start to take a little bit of a pullback, that in turn should cool off the labor market somewhat and add some deflationary pressures as well into an already very hot job market. So that could very well cause work in favor of what the Fed's trying to accomplish here. But same thing with food. When you look at goods, we, as a country, we've been very accustomed to low-cost goods because of globalization, low-cost manufacturing overseas. Think of the cost of television. They've only gotten better in technology, but they've miraculously stayed the same price relatively for years and years. But if you look at goods, supply chain issues are going to continue to add pressure in that regard. And lastly, energy. There's probably the most obvious culprit here. Energy, oil reaching over $6 a barrel in the U.S., $6 at the gas pump in the U.S., is something that every American is feeling right now. And that will in turn lead to higher food prices. It will lead to more expenditures, a bigger percent of wallet share from Americans and consumers. So there's unfortunately very little the Fed can do to control those exogenous shocks in the market as it pertains to inflation. But as I mentioned the last time I was on the show here, the best solution for higher prices is higher prices. And although we didn't get that month over month in May, I think there's a lot of hopeful people out there that June could be the month where inflation starts to peak.
Well, I hope we see that. Joe, thank you so much for being here with us today.
Absolutely, Jonathan. It was a pleasure. Thanks for having me.
And to our viewers, thank you for watching. For Asset TV, I'm Jonathan Forsgren. We'll see you next time.